most investors are getting just nauseous from the volatility. Stocks rebound sharply after April 2.
There's a good chance that the trade war is going to be 100% canceled and stocks are going to go straight up. Yes, we're going to do reciprocal tariffs on April 2nd, which Trump is calling Liberation Day. We're going to bring everything up apples to apples for here to Mexico, to Canada, to China, whatever it may be. But once we get to that level up here where everything is equal, we're then probably going to do reciprocal reduction of tariffs. So maybe the same good going in and out for one country to another is 25%. We're then going to say, let's go to 20, let's go to 15, let's go to 10. And then maybe we'll get into this scenario where we're going to have a totally free trade agreement across the entire world, where basically everything's just going to be opened up. And that could be extremely good for stock markets everywhere. And the reason why that's so good is because the reduction of tariffs is probably going to be passed on to partially to the consumer, which is us, but it's also going to be passed on to the company's bottom lines. So we're going to be able to buy things for a cheaper price. The bottom line, which is the profit and earnings per share, is going to go up at these companies. So that is going to be a very big boost for the stock market because, of course, if good prices go down, inflation's probably going to go down. And if inflation goes down, the Federal Reserve could then go lower interest rates. So if we get this setup where we do the reciprocal raising and then a reciprocal lowering of tariffs, this could be very, very, very good for the stock market.
Instead of April 2nd being the date of some sort of annihilation of trade relationships, that we may start to see either deals before then or even delays in implementation. And I think that really investors are going to breathe a sigh of relief because, as you can tell, pessimism has become very pervasive because of the fears of what will happen on April 2. So I think that's a positive. And then the other is, and it's really a technical perspective, but Mark Newton, our head of technical strategy, has pointed out there are increasing signs of that we've actually established a tradable bottom. And that's not only the fact that we declined so quickly, but it's that market breadth has really been expanding and then actually following through in a way that looks like this is not a 10% decline that's leading to a 20%, but a 10% waterfall decline / heart attack for stocks driven by rage selling, and now it's tradable. Well, I think markets should interpret it positively because I think when we talk to our clients, many are viewing tariffs as punitive, potentially protectionist, and driving several economies into recession. This sounds like that we could actually have a positive case scenario with these tariffs, one that's either mutually agreed upon or if it's reciprocal, but maybe a good deal for businesses. And I think it would set the stage for a much bigger recovery rally than we expect.
Afterwards, right?
Yes,
I mean,
after.
The problem is the paralysis, if you will, between now and then. Like, what are we supposed to do over the next 10 days?
I mean, that's the dilemma, right? Because we still have 8 trading days till April 2nd. Most investors are getting just nauseous from the volatility, so they want to throw in the towel. But we also know that markets will bottom or have historically bottomed before the event actually happens. You know, the best example is the Cuban Missile Crisis, 1962. That was a 12-day crisis. The stock market bottomed 7 days into that crisis, recovered 2/3 of the losses before the resolution. So I think that's a decent template for today.
What about the economy? I mean, listen to Nike, FedEx, put that on top of what we've already heard. Are you concerned about where the economy's going?
I mean, it's been pretty shocking how quickly sentiment deteriorated. I can understand for consumers because the president's very divisive, but for CEOs, that's been a shock. You know, CEO confidence has fallen and they've kind of been sitting on their hands. So we know there's an impulse of a growth shock underway. But if this is something that doesn't last months, then it's very temporary.
I mean, it depends, to what degree consumers remain skittish. CEOs are paralyzed in their own right because they can't really make any moves because they're not sure what's going to happen. And ultimately, whether a growth scare spirals into something else, which Jeffrey Gundlach gave me his view yesterday right here on Closing Bell. Listen.
I do think the chance of recession is higher than most people believe. I actually think it's higher than 50% coming in the next few quarters.
50, 60%? I mean, if he's right, what does that mean for the stock market?
Well,
too expensive.
Well, the S&P had a 10% drawdown. That's already priced 40% chance of a recession. I'd say the markets aren't agreeing necessarily with his view because China, Europe, Canada, Mexico have been massively outperforming the U.S. since February 18th. Those economies should be tumbling into recession if we have punitive tariffs. So I think markets are actually more paralyzed than necessarily pessimistic. And
I'm sorry, finish your thought.
But because the market is the economy, I think to the extent that stocks rebound sharply after April 2, if they do, I think it really staves off future economic
Is the market
weakness.
the real economy?
I think it's these days, to me, I think it's a really good snapshot of actual sentiment and actually even CEO decisions. Because as you know, when stocks fall, companies lose confidence. And as stocks recover, CEOs gain confidence.
What about the idea that Gundlach also put forth that in his words, unintended consequences of all of the rhetoric from the president is making people think twice, especially overseas, about investing in the U.S., and the view that Europe is just a better value and offers even less risk than before? How do you play that?
I mean, we hear a lot of folks talking about that, but as you know, Europe tends to be single stock concentrated indices. So if you're buying Europe, you're basically buying industrials and financials. If you're buying Korea, you're buying Samsung. So I think if someone is looking for the best companies, they're still going to end up buying the U.S. You know, one of the things that we have to keep in mind is this trade deal, if it's acceptable, could actually basically sort of blunt this whole issue of trade in the future, and it would actually make the U.S. more attractive again.
And this is actually setting up for a potential huge run in the stock market. So if we look at this chart right here, this is Triple Q, which tracks the NASDAQ. You can see the NASDAQ peaked out on February 19th at roughly $540 per share. But right now we're at $480 per share. And this could actually be really, really good for the stock market because just think about it. We make Teslas in America, for example, in Texas and in California. But people in Mexico that want to go buy our Teslas, they have to pay a tariff when it goes into Mexico. They're tariffing the cars as they come in. So that makes it harder for people in Mexico to then go buy the Tesla cars when they get imported in. So that is a barrier to entry. But here's the key thing. If Mexico charges us 25% when we ship a car to them, but when they ship a car to us, we don't charge them anything, that's the unfair trade rate there. So when we bring it to 25% and it's equal reciprocal both ways, then what's going to happen is Mexico is going to say, okay, let's go to 20, let's go to 15, let's go to 10, maybe we'll go to 0. So what that's going to do is cars that are made in America that we ship to Mexico, for example, it's going to be way more compelling and way more people in Mexico are going to want to buy our cars. This could be bullish for a lot of different companies.
Fed Chair Powell's comments yesterday, I think, did catch a lot of folks by surprise, just because it is a view that markets probably want to hear, that they'd like to hear that the Fed is viewing tariffs as possibly transitory, because that puts them in a position to actually intervene if labor markets start to weaken. And in fact, that's evident in the SEP, because 90% of Fed staffers now see not only risk to growth, the GDP growth forecast, but it was 90% seeing it as downside risk. Well, I think that the sort of the big elephant in the room has been the absolute fear that has become systematic in markets around April 2nd and the tariff deadline. I'd say that probably the final thing that I've seen is, and this is really from our meeting with clients, is that we know there's actually quite a lot of dry powder. Many of our clients have raised a lot of cash. I mean, it's also evident in a lot of the money market balances or prime brokerage de-risking that's taken place. And it's at a time when investor sentiment has moved far more than is justified by the market moves. Whether you look at AAII or Investors Intelligence, both have registered recession-like readings and sentiment. And so it really creates the room for positive surprise. And that, again, I think it'll, like what you just said, if tariff headlines aren't as bearish, and if there's all this last-minute work on negotiating something, and yesterday there was a tweet about how into the night Hessett and Lutnick and Bessent were, working on a trade deal that got so little notice. I think it just tells me markets could be positively surprised.
So let's go through this chart right here, and then I'm going to show you exactly how I'm going to capitalize on one of the best potential dip buying opportunities that we're ever going to see in probably years. So this chart right here corresponds to the S&P 500 on the orange line, and the blue line corresponds to the Fear Greed Index. So the Fear Greed Index right now, we're at 23, which means we're extremely fearful. Now understand that 90% of people in the stock market, they do not make money because they let their emotions get the best of them. When the stock market goes down, people freak out, they get extremely fearful, and that's usually when things are cheap. And it's funny to me because the stock market's the only place in the entire world where things get cheaper, but people want to panic sell and get out. But then when things are going up in price, they want to say, here, take my money when things are more expensive. It makes absolutely no sense to me, but that's the problem with people that don't know what they're doing. They don't know how to invest in the stock market the right way. You have to understand, and Warren Buffett's most famous quote is, be greedy, when other people are fearful and be fearful when other people are greedy. So if we flip back to this chart right here, you could see how well this correlates. So you could see on this dip right here going into 2024, the stock market took a little bit dip down. You could see on the fear greed index right here, we were roughly at 20. Right now we're at 23, which corresponds to this level right here. So you could see that this was a very fearful time in the market right here. People were getting emotional. They were selling their stocks. They didn't know what to do. But look at how that would have panned out. There's peak fear in the market right here. And then look at how quick things rebounded. Even on these little dips right here, like little dip right here, people get super fearful. The chart goes way down right here. And then bam, it goes back up. So the dip that we're on right now on the stock market, we're way down. We're super low on the fear greed index, which shows extreme fear right here. This could be a very, very good dip buying opportunity. So I'm not saying I'm betting the house and I'm putting every single thing I have onto a call option on Nvidia or Tesla or the S&P 500 or the NASDAQ. But what I am saying is that the stock market is way more compelling right now than what it was a couple months ago. Maybe we'll go a little bit lower, but the lower that we go, the more fearful people are going to get, the cheaper things are going to be. And then think about what I said with tariffs. If we get the reciprocal raising of tariffs, that's probably going to be bad for the market. But then we get this reciprocal lowering of tariffs, which overall is going to be very, very good for the stock market. The cost of goods is going to go down, which means inflation is probably going to go down, which means that interest rates are probably going to go down, which means the economy and the stock market will probably boom pretty hard after that. So understand that if that scenario plays out, which I do feel like Trump is playing chess and other people are playing checkers, I do think that if that scenario plays out, we will see a very sharp recovery in the stock market right here. This will pretty much go down like we did right here, and it'll go straight up and we'll go right back to all-time highs. This chart right here on the fear greed index will go back up, and then we'll quickly be back into the greed and extreme greed category right here. But all the people that panic and they sell down here on the bottoms, like, bottom in the stock market potentially here. This was a bottom right here. You could see bottom right here, bottom right here. I mean, it corresponds very well that every time the market dips, there's all these people with like their heads cut off like chickens, and they don't know what to do. So understand that the emotional aspect of investing is what wipes most people out. And if you really want to understand how to do this stuff the right way, how I scale to millions of dollars and generate thousands with stock options, click the link below to get into my stocks and options course. It's going to change your life. If you don't want to do it, watch this video right here. It's the 7 key things that you have to do right now in 2025 to make millions of dollars. I'll see you guys there.